how do we initially start things? What we always want to try and do is we want to kind of go from a top-down analysis. This is how I tend to do things, and I hope it's beneficial in terms of, first of all, understanding how do we read price, how do we read price structure, how do we read market structure, and what is the benefit of a top-down level analysis in terms of understanding the long-term bias and shorter-term bias of the market. So for argument's sake, let's start on the monthly. Okay, it's a very high time frame and we may not see much. So what we can see here is obviously we have got levels that we have marked up historically. We've got a huge monthly wick here that was effectively left behind with liquidity in COVID. And we can see that we have tapped into the 50% of that monthly wick this past month, or this current month rather, and we are now, it seems to be rejecting out of that. So just something to note on the monthly time frame. When we then go down onto the weekly time frame, we can see again we have two inefficient wicks that are still exposed. Again, we've got here effectively equal lows, liquidity grab on the COVID spike down, which shows you that it wasn't out of the blue. It was something that was clearly planned, and this is what kind of blew my mind last year when I started getting into institutional trading. This is a setup that was formulated for the markets to take liquidity that was left behind on this inefficient wick here. 3rd of October 2016, there were orders left behind within this bracket at these equal lows that needed to be picked up, and it was picked up by COVID lows. Okay, the market has never been that low before this point in recording history, and effectively the COVID lows were manipulated to take these lows. Okay, that may be controversial for some, but I'm saying what I'm saying because that's what the market is showing me. So we can see liquidity grab down, equal lows taken, and then reversal, breaking the bearish imbalance, rejection, retest, and then move up to the upside. So even on the weekly time frame, we can see inefficient areas of liquidity that are marked up here. They are more relevant on the daily, but we can see liquidity still sitting down here, which was then bought out of on the weekly time frame. So daily, when we go down onto the daily chart, especially in the areas that we are already interested on the higher time frame, we then want to see consolidation occur, breaking of equal highs, comes back, retests, and then moves higher. So we do have an accumulation of lows down here. These levels are more relevant. They are effectively still exposed at the bottom. We will see what the market does when it gets to that point. But we can actually unlock this. Sorry. We can move this down below the inefficient wick as our level of interest. And we are then looking at areas. Have they been mitigated? When we go across, we can see that the market has tapped into this zone. So what is the zone below this that we would then be interested in? Let's kind of refer back. On the higher time frame, we have got the inefficient wick here has been taken, but there is another inefficient wick here. Demand within demand, both on the daily, and effectively, we will look to see how the market reacts out of this to target. Seems like there's closure of orders here, but obviously there is liquidity below us. So there may be, on the lower time frame to daily, inefficiencies, liquidity within this wick that may then drive the market to bounce slightly before it then comes back and targets the larger demand zone below. Okay, so again, we are identifying areas of interest, liquidity, and key levels in stages. So we go one by one. So effectively here, demand within demand, set inside on the daily time frame. We then look for areas of interest on the lower time frame closer to us. So we can see there is demand here on the daily time frame in an inefficient wick that wicked down middle of the week, rejected out, and then kind of took off from this point to then test supply, which we will see. So again, we are not only looking at things that are relevant from the past. So this demand is still relevant for us on the daily because the market just tapped it and kissed it, as Seb says, and then rejected off. But when we go down onto the 4 hour now, we can see that the inefficient wick that formed above this level of demand actually did reject out of just touching it, and then it's kind of wicked up. Not a great move, but again, it's into areas of inefficiency and supply on the lower time frame to the 4 hour to then come back down. So again here, we identify levels and zones. We look at areas of interest. I've already refined my zones as they kind of get manipulated and created and mitigated. But again, here we'd be looking at things like mitigation of this wick to 50%. This wick has pretty much been taken. We've got levels up here, but they have been mitigated 50%. This area seems to have been covered, didn't take any real lows. Manipulation here, and then the drive and push down to take lows at this point on this wick, which liquidated this area and took 50% of this bullish wick as well. So we've already refined ourselves down with levels and areas of interest. Okay, now we're going to go down to the 1 hour, and we will then see again areas that we were watching possibly on Thursday, Friday, which we did trade out of. We took trades in this area very, very early on Friday, which are posted for everybody to see. And now we can see the areas that we marked up on the higher time frame to this, which was the 4 hour, how they played into relevance. So the supply that we had marked up as the inefficient area and wick to be targeted for buys and sells on Friday, that area was touched late Friday. Yep, 3 o'clock, and it was rejected out of. We saw a slight move out of that supply, so there was a 33 pip move there, but then the market came back and retested again. Okay, now it's retesting. We're interested to see where will it now target. So understandably, we want to look at moves for our scalping setup. So we're looking at short-term interim moves. There's an inducement here that we can see, which was kind of a bearish push down inducement for people to buy out of, liquidate them, and then move down. Now, the liquidation hasn't really happened on the 1 hour. So what we would kind of try to do is we'd say that this supply is now weakened. So we'll duplicate this, and we will now also target this area of supply as an interim supply to look and see if we get a reaction out of it. However, at the same time, we do have an inefficient wick here. Okay, so this level here as well, we're still looking to see, has that been mitigated 50%? No, it hasn't. So we're possibly looking to see whether the market comes and actually mitigates 50% of this before it creates some sort of a short-term move down to then buy out of demand here or demand here after news to then move up. So again, we'll move that level. The level of interest for us down the bottom is this inefficient wick that liquidated down and moved up. We've also got inefficiency here on this. We'll see how that plays out into key levels as well as things develop. So when we look at this, again, has not been mitigated 50%. We could probably mark that as well as an area of interest. And then obviously we've got these levels up here already marked on the 1 hour, which probably are relevant for us because we have supply above as well. Okay. Yeah, so let's have a look at why that fib is there for this wick, which is fine. Okay, we can leave it there as a key level for now. Okay, right, so what we have done is we've marked our levels of supply, demand, inefficient wicks on the higher time frame and the lower time frame to then see how these now play into our key levels. So